Today, we're diving into a fintech innovation that's reshaped fixed income investing for everyday investors, peer-to-peer lending, also known as P2P lending.
At its core, P2P lending lets you act like a mini bank, allowing you to lend money directly to individuals or small businesses, and in return, you earn interest, just like a traditional lender would.
In this episode, we'll explain exactly how P2P lending works, where it came from, the risks and rewards, and how it scores using our FastFire Investability score. That way you can decide if it deserves a place in your diversified portfolio.
P2P lending platforms first gained traction after the 2008 financial crisis. With banks tightening credit, platforms emerged helping to directly connect borrowers and lenders. These platforms handle everything from underwriting, servicing, and collections, streamlining the lending process.
As an investor, you can spread your capital across dozens or even hundreds of individual loans. Each loan has a fixed interest rate that reflects the borrower's credit profile and the purpose of the loan. Your return comes from the interest payments made monthly by borrowers.
Borrowers use these loans for a wide range of purposes, from consolidating high-interest debt to covering medical bills, funding home renovations, or launching small businesses.
Early platforms like Lending Club and Prosper helped shape the industry. More recently, companies such as Upstart have modernized the process with AI-powered credit models to improve underwriting and expand access. It's important to note that while some platforms have shifted towards institutional funding, a few still allow individuals to invest with relatively low minimums, allowing investors to get started with as little as $1,000.
Let's break down how peer-to-peer lending performs compared to the traditional stock market using our FastFire Investability scoring system.
First up, return potential. We give P2P lending a grade of C. On average, returns range from 4 to 8% depending on the platform, your chosen risk tier, and default rates. That's roughly in line with the stock market's long-term average, but unlike stocks, your original investment doesn't grow in value. You earn interest, but there's no capital appreciation. No chance your $10,000 turns into $15,000 simply by holding it.
Next is risk profile. While some loans are issued to high credit score borrowers, others are riskier. If you diversify across hundreds of loans, you can manage risk, but events like recessions can trigger higher than expected default rates. That's why we give P2P a C for risk profile.
And these loans are unsecured, meaning there's no physical asset backing them. No car, no home, no equipment. If a borrower defaults, there's no collateral to seize or sell, which significantly limits your ability to recover losses. Unlike a mortgage or auto loan where the lender can reclaim the asset, in P2P lending, your recovery options are limited to what the platform can collect through its servicing process. On top of that, your investment isn't liquid. When you commit capital to a loan, it typically remains locked in until the loan matures, usually between 3 and 5 years. There's no secondary market to easily sell your note and exit early, so it's important to understand that your money is tied up for the full term.
For accessibility, we give it a B. Most people can start investing with relatively low minimums, but some states restrict access and platforms might require accreditation depending on the structure of the fund. Still, it's easier to get into than private equity or hedge funds.
Let's walk through a practical example. Say you invest $10,000 into a P2P lending platform. You select a moderate risk profile. The platform automatically spreads your money across 200 loans. Each borrower makes monthly payments and you receive a blend of principal and interest, which you can reinvest or withdraw.
Over time, say 3 to 5 years, you might earn a steady return of around 6 to 7%, assuming defaults are within normal range.
Some platforms offer automated investing or note options with fixed yields, making it even more passive. Just choose your risk tolerance and let the platform do the rest.
P2P lending could be a good fit for investors who want predictable monthly income, are comfortable locking up capital for 3 to 5 years, accepts the risk of potential default.
It's probably not for someone seeking big growth or maximum liquidity, but it can be a valuable diversifier alongside other income-generating assets. So to recap, here's how peer-to-peer lending scores. Return potential C, risk profile C, and accessibility B.
While peer-to-peer lending may not deliver sky-high returns or offer liquidity of more traditional assets, it plays a valuable role in the right portfolio. Its income-generating potential can bring predictability and consistency to your overall strategy. Even more important, its returns are often uncorrelated with stock or bond markets. That means when equities are down, your P2P investments might still perform steadily, helping to buffer against volatility. For income-focused investors or those looking to diversify beyond traditional assets, P2P lending can serve as a steady and relatively predictable piece of the financial puzzle.
Want more detail about other alternative investments and how they score? Download our full guide to alternative investments at fastfirecapital.com/guide. And please be sure to like and subscribe to our channel. We'll see you next time.